Hey, welcome back to another episode of the Loan Officer Leadership Podcast. I'm your host, Steve Kiles. And for each of you who are listening this week, you're in for a treat because I've got my good friend, Carl Stanley with Rising Point Solutions with us. And many of you may have heard in October, we were talking about the podcast, one of our sponsors, one of the title people, core people that helped us put Insanely Tactical on was Carl Stanley with Rising Point Solutions. And so excited because you made the trip from Dallas to Houston. And today we're going to put together a podcast, really talking about what you do. So Carl, welcome to the podcast.
Yeah, I appreciate it. We were really excited to be a part of Insanely Tactical. And
it was insane, wasn't it?
Yeah, it's great.
It was crazy.
It was insane.
Well, and I got to tell you, for those of you who are listening and joined the journey and the story, we took it from idea to fruition or event in 56 days. And I've got to tell you about probably 40 days till the event, 35 days till the event, you and I got connected because I reached out. For those of you who are listening, I use Rising Point Solutions. Matt Browse is my account executive. He does a phenomenal job. And so when I was looking for support and people to be a part of what we were doing, I made a phone call. You and I end up on a call on Saturday.
Yes, sir.
Where we're talking, and you've got experience of putting on big events.
Yeah, we've put on some pretty big ones.
Big ones in Texas, and you guys know everything is bigger in Texas. And so are the events. And I just leaned into Carl for his advice and experience and what he has done to make events successful in Texas. So man, I got to tell you publicly on the podcast, I appreciate you. Plus we have a good mutual friend, Chris Blevins.
Absolutely.
Good guy. So he's over at CMG Financial. He was over at Movement for a long time. And it's interesting, Carl, life moves at the speed of relationships.
Absolutely.
So thankful for that. So hey, today we're going to be talking about credit. And that is such a sticky subject in today's environment. You know, it's funny because either you got good credit or you don't.
Right, and getting people qualified credit-wise to get a home loan is what we're all about. And it's hard sometimes because most people don't really know or understand what's going on with their credit.
Well, they don't. And you know what's interesting? 36% of every home purchase this last year was completed by millennial, and that number is actually going up.
Right.
And Carl, the crazy thing is millennials' average credit score is in the low 600s.
It's the lowest of any generation right now.
It's crazy.
Yeah.
Some of it's because they don't have credit. Some of it's because they don't understand the value of credit. So talk to us about that. What do you see?
Well, it's odd because it's changed in the last couple of years. You know, a few years ago, millennials were known for having the lowest rate of credit card debt and the highest rate of on-time payments and the highest rate of savings in many generations. And then something went sideways. I'm not sure what it is.
The Kardashians.
I think a part of it is their apprehension to use credit and apply for credit and be a part of credit. So, a lot of it I think is due to thin credit files, not having enough credit, and just trying to, stay off the radar a little bit. So thus they don't have, very good credit.
Hey, so that's a great point. So do you think when you're seeing, and I know it's an observation, but do you think it's because of thin credit, or is it because of high balances, or is it not paying bills on time? What are you seeing?
I think it's because of thin credit, student loans, and just not understanding how to manage credit because there really is no education for this generation. In high school, college, parents aren't passing that information on maybe the way they should be, but for whatever reason, a lack of education, student loans are a big player in their credit scores.
Hey, so how does, and that leads us to, how does someone who has heavy student loan debt get their scores higher? Can they?
Yeah, the student loan debt itself doesn't affect the scores that much. The reality, though, is about a third of all student loan holders are currently either in default or delinquency. So they just can't pay them.
Are you kidding?
Yeah, 1/3 of all student loan holders in the U.S. are currently not paying. And I'm not talking about deferment. I'm talking about they're either late or they're in default.
What?
Yeah.
That's crazy.
Yeah. And it's going to get worse. They estimate the next 5 years, over 50% of all student loan holders will be late, not paying because of later delinquency.
Well, let me ask you this, and this is just out of curiosity as an originator. Is there a way to help them, and how long does that typically take? Is it easy for someone who's currently in default to get that ship righted and get their scores back to a qualifying level?
So we have some student loan solutions at Rising Point. One of two things usually happens. Either the consumer is in default, wage garnishment collection, really the only thing you can do as a loan officer for that client is to get them to enter into a rehab program. And this is a government rehab program through the Department of Education.
Okay.
We can do it for them and assist them, or they can do it on their own. But they'll have to get into a rehab program, and if they do that and they make 9 on-time monthly payments, then all the previous negative history will be removed from their credit report. And that's a government program. It's a great
serious?
program. Yes, they'll start the loan over, they'll delete all the previous negative history, start with a fresh loan number, positive pay history.
Wow.
And this is basically a government second chance when you're in default to get that history off your credit, and you can restore your scores and you'll start paying your student loans.
Hey, well, that alone is worth listening to this podcast, because as an originator, to be able to give somebody that advice and then say, hey, I heard it from Matt or from Carl at Rising Point Solutions. Let me get you to people we know, like, and trust.
Right.
Hey, now, do you help people outside of the state of Texas?
Sure, yeah. We do business nationwide. There's a couple states where we don't really do business, but we can do business anywhere across the U.S. because mostly nowadays, you know how it is, everything's done by internet or screen share or teleconference, whatever it is.
Hey, and here's what I want to encourage too. Inside, many of you know we've started a Facebook group at Loan Officer Leadership. Inside of Facebook, look for the group. Make sure you're a part of the group, because Carl, you're in there. And so we can start a conversation. Even, if you want to know how to get in touch with them, we're going to give you information at the end, but join the group, because these are things we want to know about as originators. They're huge tools.
Yeah, I think I'll be the resident credit expert for
I'll take it, yes.
And anytime anybody has a question about credit or they're looking for a resource for one of their clients, you can just ask in that group, and we'll make sure that we get you the help you need.
I love it, man. You're a great strategic partner, and especially in helping originate more loans. So talk to originators. How does Rising Point Solutions help, or how can you help originators close more loans?
Well, I think at the end of the day, for us, it's what we want to do with our loan officer partners is provide them an opportunity to never have to say no, and so it's not no, it's just not yet. And every lead is valuable, every lead is gold, and we want you guys to view it that way. And every lead's an opportunity. So rather than putting it in a dead file or sliding it off into the trash can, everybody deserves a helping hand. Not everybody's fixable, but if you can focus on the loans you can close and let us help you on the other ones, and we can help you close an extra 3 or 5 or 7 deals a year, that's valuable, and that's what we try to do. Yeah, but because at the end of the day, if we can help you make more money, that's the value in our partnership.
I love it.
Both ways.
Well, and you were saying, so really helping clients to qualify with qualifying credit scores. So you do that now. When you're working with clients, what does it look like? Is it a monthly? How are you helping them each month? Is it you review their credit, and then you take and say, over the next 3 to 6 months, here's where we think you can get your scores?
Right, So when we work with our loan officer partners, our job is to help you close more loans.
Yeah, for sure.
Our only job is to get that client across the finish line. Sometimes that includes our program, sometimes it doesn't.
Yeah.
Sometimes we'll get on the phone with your customer and just give them free advice. Or we'll make one of our resources available to them. Or we'll reinforce something you say. If we can't help them or help you get around the corner in 45, 60 days, then we'll do a consultation with them, and we'll give them a more hand-holdy option that maybe takes 4 to 6 months. And they'll get a blueprint. They'll get homework. They'll get a blueprint, exactly what they need to do over the next 4 to 6 months while we're working on their credit to become a homeowner.
Hey, and Carl, what do you think what are some of the keys? Like, if you were to say, most people should know this, but here's the top 2 or 3 basics that help keep you at a higher or the highest credit score that's possible. So, like, I've heard things like, in consumer debt, on credit card debt, if you're 30% or lower than the high balance, that's the best place you can be. What are some of those things? What are some of the basics we should be talking to clients about, saying, this is going to get your score higher, this is going to get your score higher, this is going to get your score higher?
Right, and we have a document internally that I can and maybe
post on the group.
Out,
I'd love that.
It's basically what we call it is it's like a loan ready document. It's like, hey, these are the things you need to be doing with your credit before you apply for a mortgage.
I love that.
But some of the basic stuff is this, and most loan officers do think the correct percentage is 30%, but it's really 1 to 19%. So instructing all of your consumers to try to line up their credit card balances, their revolving debt in that 1 to 19% category is important. Making sure they have enough open trade lines and they have each box checked. So before they apply for a mortgage, they should make sure they have some installment credit and some revolving credit with good pay history.
So what's some? How many? 2 or 3?
When a client is referred to us by a mortgage partner, or they're coming through another channel, and we know their goal is to buy a house, we're going to make sure they have a minimum of 3 open trade lines. So we want to see 3 open trade lines, at least 1 installment account, and usually 2 revolving accounts. So 3 trade lines, 1 installment, 2 revolving. That's a baseline for us, and that's going to help raise the scores, because having positive credit is just as important as the potential bad credit that might be on there.
Yeah, well, it's interesting even when you're saying 3, so 1 installment, 2 revolving.
Correct.
Right, and that's a baseline.
That's a baseline.
Can you have too many accounts even if the balances are low?
So officially in the scoring models, no, you can't have too many accounts. If you want to have 40 credit cards, you're not.
Which is overwhelming.
Yeah, you're not getting penalized for having 40 credit cards. The caveat to that is there is a scoring factor called accounts with balances. So if all 40 accounts have balances, then yeah, it's going to start helping you. But you have to have a lot of credit with a lot of balances to have too much credit. That's kind of a myth.
Yeah. So, and the key is you just got to pay on time, keep your balances low based on the high credit limit. What else? What are some other tools?
Pay on time, keep your balances low, and make sure you have enough open positive credit. See, there's thousands of scoring factors that go into the FICO scoring models, but they all roll up to one of those 3 categories. Good credit, bad credit, and balances. So if you avoid bad credit, have enough open good credit, and pay on time, keep your balances below 20%, you'll always have a great credit score. But that's easier said than done sometimes.
Hey, well, talk to me about this. Medical collections are a bigger deal in today's environment, because with insurance the way it is, I know for me personally, you're like, I hope I remembered to pay that $50 that wasn't covered in my copay, and you get it, and you see it in your clients, and it becomes a nuisance.
Well,
but does it affect credit scores, or is it, talk to us about what medical collections look like, medical debt looks like, things like that.
There's a myth. There's always been a myth amongst consumers that medical bills don't hurt you, or they don't hurt you as much, and a lot of that's perpetuated by the fact that most lenders don't care about medical bills. So while you don't care about it to underwrite a mortgage loan, it's they're not required to pay it. You don't really care that it's there. It's still affecting the score just as much as any other collection. So if you have a $100 medical bill, it's going to be affecting your score as much as any other bad debt on your credit report.
So it does affect you.
Medical bills kill your credit score just like anything else.
That's interesting.
In the newer score versions, FICO 8, FICO 9, and future versions, they're devaluing medical bills. But the reality is the mortgage industry still works on an old scoring version from 1999, the most harsh version, and that's what you're still dealing with.
That's funny. Do you think that's going to change anytime soon?
I get that question all the time from loan officers. Hey, when are we going to move to the new scoring
to
models?
A modern model.
Yeah, the FICO 8 and FICO 9 models came out in 2008 and 2015 respectively. You guys are working on a 1999 version. It's the strictest scoring model. And when they do move to a new model, the average mortgage applicant score is going to go about 30, 40 points.
Wow, that's a big deal.
That's mostly going to be people who have damage or bad credit. The people with good credit scores are pretty much going to be the same. But it'll benefit everybody when they move to a new scoring model. And medical bills are devalued, and there's some other really positive changes in the new scoring model.
Wow, that's great. Hey, well, listen, one of the interesting things, I hear it probably at least a couple times a week. I've got a 750 credit score on Credit Karma. You and I were joking a little while ago. That's your fake score, right? Talk about that.
FAKEO versus FICO, right? That's how we refer to it. So
that's the funniest, because they'll say, hey, I've got a 740 credit score. Based on what? Well, I just saw Credit Karma, and I almost laugh. And it's like, it's always the objection, and when that is said, 9 times out of 10, I know I've got somebody coming in with bad credit.
Right.
Which is the funniest thing, because I hold my breath. I'm like, ooh, better pull that credit now.
Yeah, and the thing about all those credit monitoring sites and Credit Karma, and Credit Karma is just one of them. They get picked on a lot because everybody knows them, but there's 30 or 40 credit monitoring sites. They're all owned by the bureaus. They're all pushing out, consumer-based scores, not lender-based scores, and it creates a lot of confusion for the customer, because they don't understand it's basically just a fund score. And and the reason they do that is there's a lot of advertising that goes on with those credit monitoring sites. I think the bureau, if you think your credit's better than it is, you're probably going to be more likely to apply for their products and maybe not hold them accountable when there's errors on your credit report. There's a reason everybody on Credit Karma commercial has a 720, right? And so, but the reality is,
it's probably not true.
Yeah. The reality is, a loan
That's
officer
funny.
is your consumer's 2 levels away from a mortgage score. They're 1 level away because they're looking at an online fake score, or fund score.
Yeah.
But even within FICO, their auto score is not a mortgage score, and they may say to you, "Hey, I bought a car a couple months ago, and my score was 650."
Yep.
Well, that's when you buy a car. There's a different scoring model for mortgage, and it might be 610. So they're 2 levels away. They're they got to get to a real lender score, a FICO score, and then even within FICO, mortgage is the harshest, and they don't understand that.
Hey, well, while you're saying that, I tell people that credit scores were designed for mortgage and auto industry.
Right.
Help me rephrase that. So, it's interesting because I'm trying to give an understanding, or what I know, my limited knowledge about credit, to a consumer who's looked at a fake fund score.
Right.
And then you're exactly right. Then somebody went and bought a car, and they say, well, hey, 4 months ago I bought a car and I was at 780. Why is that even different from where the mortgage is? So explain that a little bit. What FICO? So what were you talking about that?
I mean, a lot of days, banks and credit card companies are offering credit reports and scores, and those are FICO scores, but they're going to be a bank or credit card score, not a mortgage score, right?
Crazy.
So they see it on Capital One.
So much confusion.
Right, and so the best way to explain it is we have different scores based on what we are purchasing. The risk for the lender is based on what we're purchasing and how we've serviced that type of debt in the past, right? So if I've paid a mortgage on time for 10 years, but I've had 4 car repos, I'm sure my mortgage score is going to be higher than my auto score, right?
Yeah.
And vice versa.
Yeah.
Or I've always paid my mortgage and car on time, but I've had 10 credit cards go bad, I'm going to have a low credit card score. So you're underwritten by lenders based on what your priorities are and how you've serviced that type of debt in the past.
That's huge. That's a great point. Hey, we'll do this for our listeners who want to get connected with you. You'll be in the Facebook group, so Loan Officer Leadership group. Check that out. Go to our Facebook. We're really working hard to build a community there because we want the dialogue back and forth. So I do want you to post that document. Eli will follow up on that. But tell them how they can get in touch with you.
Well, you go to our website, risingpointsolutions.com. There we have a listing of our different account reps in different areas. So, wherever you are, there's probably an account rep at Rising Point that can help you. You can reach out directly to me in my email, and we can get acquainted that way, and I can introduce you to somebody that can help you. My email is cstanley@risingpointsolutions.com. So it's CSTANLEY@risingpointsolutions.com. And heck, I can give my cell phone number if you want, but
we just go to the group.
Yeah,
so here's what I tell you.
I'm going to post my contact information.
Yeah, please do. Well, and here's what we'll do too. When we send out the podcast, we'll tag you where you can click on his social profiles, DM him, send him a message. Hey, and with that, guys, thank you for listening each and every week to the podcast. Carl, thank you for coming on.
Yeah, thanks.
Man, it's great to have you here. Not only is he becoming a fast friend, but they're a great strategic partner. Loan officers, if you're looking to grow your business, I know that personally I've struggled with, in the past, who do you refer that's reputable? I mean, the credit, it's so saturated with crooks and con men, and you almost would say, I don't know anyone. But ever since I've been working with Matt, absolutely, I've got someone that I can highly recommend. And so start working with Carl, start working with Rising Point Solutions. Join us in the Facebook group. We want you guys to connect with us. And our commitment to each listener is we're going to help you get better. We're going to provide relevant content, relevant solutions, things and tactics that are going to help you grow your business. So I'm asking you, join us on this journey to get better. Hey, make sure you're subscribing to iTunes. We release the podcast every Thursday. It is released on Thursday mornings. That way it comes right to you. And then make sure to share it with somebody else can benefit from what we're doing here at Loan Officer Leadership. So with that, #grow and grind. Be purposeful in your growth, relentless in your effort. Remember, anything worth doing is worth doing badly. Just get started. See ya!